How to pick stocks for 2026. What if 2026 becomes the year the market stops rewarding hype and starts rewarding discipline? For the past few years, investors have ridden waves of AI explosions, meme stock frenzies, rapid interest rate hikes, and geopolitical shocks. Some made fortunes overnight. Others watched gains disappear just as quickly. But 2026 is shaping up to be different. Capital is no longer free. Risk is priced more aggressively, and volatility isn't a temporary phase, it's the new normal. Decisions from the Federal Reserve still ripple through global markets. AI leaders like NVIDIA dominate headlines. Let's watch. 1. Understand the macro landscape before picking individual stocks. Every company operates within an economic environment. Ignoring that environment is like sailing without checking the weather forecast. In 2026, decisions from the Federal Reserve will continue influencing liquidity, credit availability, and investor sentiment. When interest rates are high, borrowing becomes expensive. Companies dependent on cheap capital struggle. Consumers reduce discretionary spending. Valuations compress. When rates decline, risk appetite expands, and growth stocks often surge. But rates are only part of the equation. Inflation trends determine purchasing power. Geopolitical tensions affect supply chains. Trade policies influence semiconductor manufacturing and rare earth access. Election cycles can reshape taxation, regulation, and infrastructure spending. For example, if defense budgets increase globally, aerospace and military contractors may see multi-year tailwinds. If governments expand clean energy incentives, grid modernization and battery storage firms benefit. If consumer confidence drops, luxury and non-essential goods may slow dramatically. Macro analysis doesn't tell you exactly which stock to buy, but it narrows the field. It tells you which sectors are likely to have tailwinds and which may face structural headwinds. In 2026, ignoring macro conditions could mean investing against the tide. 2. Focus on earnings quality, not just revenue growth. Revenue growth excites investors. Earnings quality sustains them. Many companies can grow sales by cutting prices or increasing marketing spends. Fewer can convert that growth into durable profits and free cash flow. In 2026, investors will likely reward companies that demonstrate operational efficiency, pricing power, and margin stability. Consider companies like Microsoft. Its strength isn't just revenue expansion. It's recurring subscription models, enterprise contracts, and cloud dominance that create predictable cash flow. Predictability reduces risk. When analyzing earnings quality, look at gross margins, operating margins, and consistency over time. Are profits expanding alongside revenue, or is growth being subsidized by debt? Is free cash flow positive and rising? High-quality earnings allow companies to reinvest, acquire competitors, innovate, and return capital to shareholders. Weak earnings force dilution, borrowing, or cost-cutting desperation. In 2026, sustainable profitability will separate strong investments from fragile ones. 3. Identify structural trends that will shape the next decade. Short-term catalysts can move stocks temporarily. Structural trends move them for years. Artificial intelligence is now foundational infrastructure, not experimental technology. Companies powering AI hardware like NVIDIA have experienced massive growth, but the ecosystem extends beyond chips into cloud computing, data centers, cybersecurity, robotics, and enterprise automation. Energy transformation is another multi-decade shift. Electrification of transport, battery storage innovation, and renewable grid integration continue evolving. Companies such as Tesla operate at the intersection of EV production, AI software, and robotics, reflecting how overlapping trends create amplified growth potential. Demographic shifts also matter. Aging populations increase healthcare demand. Emerging markets expand middle-class consumption. Defense modernization responds to geopolitical instability. Supply chain reshoring boosts domestic manufacturing investments. The goal is not to chase every hot narrative, It is to identify trends with staying power and find companies positioned to benefit consistently over time. In 2026, aligning with structural forces increases the probability of long-term compounding. 4. Demand valuation discipline even in bullish markets. A wonderful company can become a disappointing investment if purchased at an inflated price. Valuation is often ignored during euphoric rallies. Stocks detach from fundamentals as momentum traders pile in. Companies like Palantir Technologies have experienced dramatic swings driven by expectation cycles rather than steady financial progression. In 2026, valuation discipline may matter more than ever. Analyze price-to-earnings ratios relative to growth rates. Compare price to sales multiples to industry norms. Examine free cash flow yield. Ask whether future growth assumptions are realistic or overly optimistic. Buying quality at a reasonable valuation provides a margin of safety. Even if growth slows slightly, downside risk is limited. Overpaying removes that cushion entirely. Markets eventually reconcile price with performance. Valuation discipline protects your capital during that reconciliation. 5. Examine financial strength and capital structure. Balance sheets reveal resilience. Companies carrying excessive debt face amplified risk when interest rates remain elevated. Refinancing becomes expensive. Credit downgrades increase borrowing costs further. Financial strain limits strategic flexibility. Strong balance sheets, however, create optionality. Companies with significant cash reserves can weather recessions, acquire struggling competitors, invest in research, and maintain dividends during downturns. In 2026, financial strength may act as a competitive advantage. Firms with low leverage and healthy liquidity can expand, while weaker competitors retrench. Review debt-to-equity ratios, interest coverage metrics, and cash positions. Financial durability often determines which companies survive prolonged volatility. 6. Diversify strategically across economic drivers. True diversification is not about owning dozens of tickers. It's about owning businesses driven by different economic forces. When one area slows, another can strengthen, and that balance is what protects long-term wealth. Technology often thrives during innovation booms and productivity cycles. Consumer staples tend to hold steady during recessions because demand for essentials doesn't disappear. Energy stocks move with commodity prices and global supply dynamics. 7. Think like a business owner with a long-term horizon. The final principle is psychological discipline. Markets move fast, headlines move faster, and emotions move fastest of all. Legendary investor Warren Buffett built extraordinary wealth by focusing on business fundamentals rather than short-term price fluctuations. He treated stocks as ownership stakes in real companies, not speculative chips to trade in and out of. Adopting this mindset transforms how you make decisions. Instead of asking whether a stock will rise next week, ask whether the company will be stronger 5 years from now. And don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.